This is Spotlight Omaha. Spotlight Omaha is a local podcast that highlights local businesses and influential movers and shakers in the Omaha business community. Spotlight Omaha is brought to you by Pixel Fire Marketing. Now, from the Pyramid Contractor Studios, the host of Spotlight Omaha, Jimmy Allen.
Good morning, everybody, and welcome inside the Spotlight Omaha podcast, where we take you around the city of Omaha, introduce you to local business owners, influential figures, and people who are making an impact on our community today. We are brought to you by Pixel Fire Marketing. Pixel Fire Marketing is a locally owned marketing firm that specializes in website design, creating social media ads, and engaging your business online. If your business could benefit from any of that, check out pixelfiremarketing.com. Today, joining me inside the Pyramid Contractor Studios, Alex Drake of Lincoln Federal Savings Bank, member FDIC, equal housing lender. We've never done a podcast together. We've never done any radio. I've never met you before in my life. No, man, we've tried doing this a couple times. Glad we're able to do it.
Yeah. Obviously, the first time we were going to do it, I ended up going through a job change, and then last time you had
my entire family got sick.
Yeah, so that I think that's one of the perks of kind of what we do. We have flexibility to make things work when we need to. So
you just mentioned it. You made the move over to Lincoln. Why was it the right time for you to make that move, and how is it going so far?
Yeah, I think the first thing is I had started the process with my former boss, who is now my current boss again.
Sure.
And kind of transitioning to a slightly different role than I was in, which is weird to say, right? Because when you think about a mortgage loan officer, you're a mortgage loan officer. You help people get houses. But I was just in a different position that, part of it was, within the company, just so many other loan officers. But also
it's almost a supervisory-esque role.
Yeah, well, not so much that. It was just like it was really hard to set myself apart from colleagues within the same company because there was just so many of us.
Okay.
So anytime I would call on somebody, as far as a potential referral partner, they already had somebody at that company that they worked with regularly. So, and then also where I sat, and nothing against where I sat. I loved it, but I sat inside a real estate office, which really kind of at times
hindered you,
limited my ability to market to outside of those offices.
I want to talk about the aspect of so many options out there. You mentioned you came from one bank and now over to Lincoln Federal Savings Bank, but I think everybody knows a real estate agent. Everybody knows a loan officer to some degree because it is a large pool of people. What do you do personally to differentiate yourself now that you do have kind of a little more runway to do so? Yeah,
so a couple of the big things for me right now is I think our platform as a bank at Lincoln Federal allows me to serve realtor partners and referral partners a lot better. It gives them some freedom. One common thing that we say is 90% of the business in real estate is done on nights and weekends. And I always answer my phone, or try to.
Sure.
I do my best. I answered my phone 20 minutes before walking down the aisle for my wedding. I answered it on my honeymoon.
Does your wife know this?
She knew about the honeymoon.
She does now.
She knew about the honeymoon.
Yeah.
But at the end of the day, like sometimes for a real estate agent, time is of the essence when you're trying to write an offer. And so on our platform, they don't necessarily always have to wait for me to update their pre-approval. If they download my app and sign on as a partner with their client, they have the freedom to go in and lower that letter if they need to lower it.
Can you explain what that means to anybody?
Yeah. So when you get a pre-qualification letter, it's up to a certain amount. And let's say you're pre-qualified up to $375,000, but you want to go write an offer on a house that is $340,000. You don't necessarily want to show all your cards to the seller for whatever reason.
Right.
And, if it's 8:00 on Friday and that offer is due at 9, that realtor has the freedom in our app to go lower that letter, which is not uncommon in the lending space. A lot of companies have this feature. It's new to me, but at that rate, you have the ability to, not necessarily call me, because at the end of the day, if you have 20 minutes, 30 minutes to write an offer, whatever it is, and you call me even if I'm available, a lot of the times it takes 20 to 30 minutes just to get into our system when we're remote. So you have a little bit more flexibility.
I think a lot of people look at the banking industry and think old school, things are set in their ways. We had Doug Nodgaard on here. He talked about good old boy loans and how those are going away and things like that. But obviously, when you talk about technology and having instant access to your clients and the people you're trying to help, how has technology kind of changed the way you're able to operate as a lender over the last 10 years or so versus when you first got into the industry?
Yeah, so it's crazy, right? Like at my last institution, in the middle of the pandemic, huge investment in technology, which
had to,
it was already coming down the pipeline, right? Just new systems that allowed us to do so many different things, and then the change here to Lincoln, some of the things that I'm able to do to stay in front of my clients better after a transaction, right? And then, track my realtor partners and see how they're doing and be able to congratulate them and help them celebrate their successes.
Is that a big deal for you?
It's huge.
Yeah.
So when I meet with a realtor, my biggest thing for forming those new partnerships and those relationships is, one, we have to align in a lot of areas. We have to align with how we care for our clients. We both have fiduciary responsibilities, which I take very seriously. So my number one thing is we have to align there. We have to be able to talk to each other in a respectful manner, and we have to get along.
It's got to be some sort of a partnership.
I really like doing business with people I get along with and that I'm friends with.
We've had a couple of financial advisors do this podcast, and they've explained what fiduciary means. And I've been kind of interested because I've gotten a kind of a different answer from each single person what that word means to them. Can you talk about what fiduciary is for any that may not know and what it means to you?
Yeah, so I mean, at the heart and soul of it is whether you want to go by definitions, right? Like in some world, I'm an advisor to my clients. And I'm the subject matter expert. And I'm supposed to do my best to protect them while setting them up for financial success down the road.
And what does that mean to you?
Having tough conversations with them about, budgets and where you want to be realistically, but also understanding their lifestyle.
Sure.
My wife and I just bought a house, and I think I've told you this. I probably have to dial back a little bit of how I talk to people, because some of it went way overhead. I think one thing that we do in the industry is sometimes we forget that the clients that we're helping,
subject matter expert.
They're not doing it all day, every day. So yesterday I talked with a client that I had pre-approved 18 months ago, and they just never squeezed the trigger.
Sure.
And we talked for 45 minutes about all the different things that you can do pricing wise, in terms of getting a better rate to make that payment more manageable. And in some cases that might involve offering more for the house, right? So theoretically you could, on a $350,000 house, you could offer $360,000 if that house appraises. In that offer, you also ask for $8,000 to $10,000 in closing costs credit from the seller for whatever reason. You can use that money to buy down the rate instead of you buying it down yourself. I mean, there's a lot of different things. And I think from where I started in mortgage, I again, we've had this conversation a lot, but I started in like a telesales role. Kind of like a cube jockey, a phone jockey, whatever you want to call it, just turn into
cold calling. Yeah.
No, not so much. A lot of it was inbound, but there was so much of it that I got so many different scenarios and opportunities instead of what a lot of people do when they get into the industry is they start and essentially in a role that I'm in now, and you have to start by networking and going out and finding deals, where I started in a role where I was fed a lot of deals and I got to see so many different things, and it really, really helped me figure out how to like be creative with the financing in ways that you can. You
can't like see the path that you didn't take, but do you feel like that was set you up better for success than maybe the other alternative?
Yes and no. I think there's give and take to both. I think I would probably have a more robust system in place if I was out hitting the streets like I am now,
Yeah.
pre-pandemic. But I would not have learned all the different things I've learned from different areas. Like, one of the best things about sitting in the call center environment was I got to sit next to a lot of great loan officers that have been doing it for 20 years.
Pick their brain.
And yeah, they sped up my learning curve super fast.
We're catching up with Alex Drake here on the Spotlight Omaha podcast, brought to you by Pixel Fire Marketing and Pyramid Contractors with Lincoln Federal Savings Bank, member FDIC, equal housing lender. I want to ask about when we talk about the first meeting with somebody that's looking to buy a home for the first time, what are some of the misconceptions or maybe commonly asked questions that people have that are looking to buy a house for the first time?
Well, so, I mean, I'm going to push back there. I think every one of those conversations is a little bit different.
Sure.
Because everybody's background in terms of how they handle finances, what they know about finances are wildly different. So my first consultation with first-time buyers, one big thing I have is I never pressure them to fill out an application up front, because they need to align with me. Like, they have to like me.
Sure.
Their realtor has to like me.
I guess that's the dumb question. So, why? Because there's an application fee, essentially, right?
No, there's no application fee.
Okay. So why not put in the application?
Just because I want people to feel like they're making the decision.
Sure.
Right.
Okay.
So in our first consultation, we talk numbers. We talk what they know, what they think they know, and I do my best to paint the picture of reality for them, because there's a ton of misconception out there on TikTok, Instagram.
I'm pre-approved for $5 million.
Yeah, there's tons of stuff out there. So I really want to have a down-to-earth, serious conversation with them, and then I send them home with a little bit of homework. I send them home with 3 big questions up front. What is your plan for this house, short and long term? Meaning, are you planning on this being your forever house, which is highly unlikely?
Yeah.
What is the biggest check that you can stomach writing at the closing table, all in? And what is a payment that you are comfortable monthly?
How many people are surprised, especially walking through for the first time? And I mean, obviously, on any numbers, but like percentage wise, that there are closing costs, or don't know that, hey, I do have to write a check at the end of this, or there's negotiation tactics to maybe have the seller, et cetera.
I think so many people, because we've been our generation specifically, we've been hammered with the myth that you have to have 20% down, right? And
I thought when we bought our house, I thought for sure we did, and then
and obviously if you can do 20% down, that's great.
Yeah.
I have this debate with people a lot, especially financial gurus who say never do.
Yeah, because the numbers worked out better for us not to do it. Yeah.
Yeah. Sometimes it might. I always tell people, while you might feel mortgage insurance is a ripoff or a scam, I view it as a tool. I view it as a tool to get into the house, to start to build that equity.
Yeah.
Your house appreciates at a rate faster than you can save, typically, as an average American.
Yeah. And
that means when you do eventually save up to that 20% on the $300,000 house that you're looking at, that house is now 30% more expensive. Right. So you're behind the 8 ball if you always play that way. Now, that's not to say don't do it, but if you, for whatever reason, you have an expanding family, this or that, and you need to get into a house, 3% down as a first-time buyer is totally doable. 5% down. But to go back to your question, so many people think it's just down payment, and there are a ton of costs. There are, when I say a ton of costs, I mean a bunch of different little things that come up. Like you're looking at a $500 to a $600 appraisal. Yeah. If you choose to do an inspection, you're paying that up front out of pocket. You have title insurance. You have homeowners insurance that you have to buy, and that's part of your cost up front. Yep. You pay a whole year up front.
There's this cool thing called taxes.
Yes, taxes. So the amount, like, somebody will tell me that they have $25,000, $30,000 to put down, and my question back to them is always,
what about after that?
Do you have anything else set aside for closing costs?
Yeah.
Or do you want me to factor this with $35,000 bottom line?
How many people, when we talk about the like everything you just encompassed there, like give me a percentage of people that walk in, understand all that upfront. It's got to be less than 20%, right?
Yeah, I don't think anybody understands it up front. I mean,
sure.
I've been doing it for over 7 years as a mortgage lender specifically, and there are times where, with the changing guidelines and regulations that happen all the time, there are times where I'm
about
like,
2 to 4 years. Yeah.
I need to take a step back. I need to dive back in and and re-educate myself on some things. But that comes with the territory. So I think the biggest thing is, for me as a lender, and for most lenders that are successful in this industry, is you make the client feel comfortable asking you the questions.
Good point.
So all my clients get access to my cell phone. If I'm available, I'm answering the call, I'm responding to the text. They all have my cell phone number. All the agents I work with have my cell phone number. I'm very accessible. And if you're not comfortable asking the question, then you quite frankly, you're probably...
You need to ask it.
Yeah, you need to ask it, and you're probably working with the wrong person if you don't feel comfortable asking it.
Anybody that follows you on social media knows you're very prevalent about what's going on in the rate market. Mm-hmm. What are rates doing today? What are they not doing? But it's ever changing, right? And when we go through maybe the most unique time in human history with the pandemic, they're dropping, they're raising. You have inflation that's being affected by it.
Yeah.
You have stimulus checks that are inflating the economy to help balance the rates. How do you personally not only keep your finger on the pulse of what's going on with rates, but make sure that the people that you're working with, because a lot of times some people are waiting for that 1 point drop, half-point drop to happen before they pull the trigger. How do you keep up to date with that, and how do you keep your clients informed as well?
Yeah, so in the current environment that we're in right now, I always tell somebody, hey, if you're comfortable with that payment where it is today and you're under contract, squeeze the trigger.
Sure.
Because depending on the loan amount, right? The loan amount plays a big factor here. But depending on the loan amount, every 1/8% is somewhere between...
Well, 1/8% is a lot more on a $400,000 house versus a $200,000 house.
Right, 100%. Yeah. But, at the same time, if you're affording the $400,000 loan versus the $200,000 loan, it's relative.
Yeah.
But I think it going up hurts you more than it going down helps you if you're comfortable with that rate.
I agree. Yeah.
So I always tell people, we'll look at the opportunity to buy points, to buy down that rate a little bit to see if it's feasible, if it makes sense. Conventional wisdom on that says, so let's say you're looking at a $350,000 house or loan right now, and you're looking at XYZ rate. If you pay $2,000 up front to lower that rate to this, does your monthly savings on principal and interest, does that total that $2,000 in 36 months? If the answer is no, then we tell people that's probably not a good idea when it's coming out of your own pocket. So we do some cost analysis there, things like that. I'll tell you, again, this goes back to a conversation I had with a client yesterday. When we went under contract for our house back late September, early October, the rates that we were quoted touched 5.875 for all of 4 hours. And at the time,
hasn't been back.
At the time, my loan officer and I both thought that they were going to continue to come down.
Sure.
Fed was meeting, they were going to lower rates, which, being in the industry, I know that doesn't directly tie to mortgage rates.
Right.
And the exact opposite happened. So, sometimes we're wrong. And I tell clients when they ask for my advice on that, I always tell them,
you're a poor man's weatherman.
Yeah. I tell them pre-COVID, as a loan officer, I had a shot at being 50-50 shot at being right on what rates we're going to do tomorrow.
And post-COVID?
Post-COVID, I would say it's 1090. There's a lot of things.
And inflation, stimulus checks, things that have gone to the market have changed what that looks like.
Right.
So that's understandable.
And, sometimes the market acts exactly opposite of what you would expect. So several times over the last couple of years, the Fed has come out, announced after a meeting that they were going to raise rates by 1/4 point or whatever, and the mortgage rates dropped because of how the market reacted, which is totally counterintuitive at the very base level. So right now we're in a super uncertain time for the economy with rates. Now the economy still appears to be strong, which should feel good to most people, right? The economy appearing strong should feel really good to us, but I think a lot of us feel differently based off our wallet size.
Well, not even that, but do you think a lot of that is sorry, I don't know what's going on with my voice. But do you think a lot of that is what happened in 08? Like a lot of people, like the housing market crash, and then we've seen 2 recessions now since then as well. I think a lot of people have kind of learned from the, hey, it's really good right now, or things are on a positive trajectory, but that means the shoe's going to eventually drop.
I would say from a real estate specific standard, I would agree that the general consumer base feels that way.
Because I mean, even before that, you had the .com boom, then the .com crash, and then you had the housing crash, then you had the recession, then you had the bubble bust, and then you had
I think
bull market, and then now you've obviously seen the retraction in the economy as well.
Yeah, but to your point, I think when it comes to real estate and home buying, I feel like the general public feels that way.
Sure.
I have that conversation a lot
because it's your largest investment for most people.
And I've had numerous clients tell me that they're going to wait for the bubble to burst. Specifically here in Omaha, though.
Yeah.
There's not really a bubble because we have a housing shortage.
Yeah, I was going to ask about that. So, we're catching up with Alex Drake from Lincoln Federal Savings Bank, member FDIC, equal housing lender here on the Spotlight Omaha podcast, brought to you by Pixel Fire Marketing and Pyramid Contractors. Every real estate agent we've talked to has almost to the number known exactly how many houses are on the market, and it's very rarely over 1,000, specifically over the last couple of years. How does that affect you guys? Because people obviously got to have houses to buy, but there's always a moving market, so it's a little bit different for you guys. How does that affect you guys?
I mean, it affects us a lot, right? Like if there's low inventory means low applications.
Sure.
And so I just had this. It's funny. I do this for a living, right? So I have these conversations all day, every
basis,
day. Yeah. In my new office, there's several...
I just asked Angie to kill the heat, by the way, so it's going to get a little cooler here in a second.
I'm going to start pitting out, and we have a game to do today.
Yes, we do.
But in my office is an entire financial firm, multiple teams of financial advisors in our building. And I was having a conversation with one of their agents yesterday. Excuse me. Now I got your cough. And he brought up some quote unquote alarming data around the housing industry where purchase applications are at the lowest that they've been since like 1992. My pushback to that is a lot of the way things like that are reported, I don't think are truly indicative of buyer demand, meaning
it's all relative, right?
Well, no. So applications reported for this are strictly house accepted offers. That's when it becomes an official application by government standards.
Sure.
So, you could have a massive increase in people applying for pre-approvals and pre-qualifications, and that number still be low because of the housing inventory. But I think numbers like that deter people that are interested in getting into the market.
Are you ever working with individuals looking to buy multifamily homes or like duplexes or things like that? And how does that differ from a single family, if at all?
Yeah, so I can go up to a 4-unit.
Okay. Is there a reason?
That's just what Fannie Mae and Freddie Mac consider personal property loan.
Oh, gotcha. Okay.
Anything more than 4 becomes a commercial.
Okay, gotcha.
And
how does that differ when you're having that conversation? Because oftentimes not, people aren't buying a 4-unit to move into it. They're buying it as a rental property. How does that differ for you personally?
Yeah, I mean, so, to your point, yeah, a lot of people are trying to buy a 4-unit as an investment property. I haven't ran a ton of those. Somebody coming to me to buy a 4-plex as an investment. I've had them. I want to buy it as a primary and rent out the other 3 or things like that. And depending on the program, it gets tricky. So I ran into this last year. The deal wasn't mine, but I was walking a realtor through it. VA loan, VA required, unlike FHA would, I believe. Now I'm going to have to go back and check the guidelines. But
sure. It's probably changed since we started this podcast.
Yeah,
anyway.
So let's back up. On a conventional loan, when you do that, you could use prospective rents from the appraisal on those other 3 units. You could take 75% of that rent, use it as income to wash away a portion of your mortgage payment to help qualify. On a VA, they require 2 years of you collecting rental income, period.
Before they'll include it?
Yeah, so you have to qualify for the mortgage on the entire property by yourself if you don't have 2 years as a landlord history.
How often are people who are first-time home buyers benefiting more from a conventional loan versus a first home? Because it happens, right? But
so
is that pretty rare or is that pretty common?
Misconception. FHA is not first home.
Okay, I'm sorry. Go ahead. What is it?
So FHA is Federal Housing Authority.
Okay, gotcha.
Or Federal Housing Administration. So anybody can use an FHA loan. And that is a minimum of 3.5% down.
Sure.
Depending on the price range, FHA can be tough to get done, especially in the spring and summer markets, because their appraisals are just a little bit more strict. Same with a VA, though. So VA, USDA, FHA, those can be harder sometimes for a buyer to get an accepted offer. I don't necessarily agree with that, but that is something that I've seen, especially in the post-COVID world.
Sure.
During the pandemic, when everybody was buying and paying over asking, conventionals are just cleanest and most streamlined from that aspect for whatever reason. Again, that doesn't mean I agree with it, but you as a first time as a first time buyer, if you have really strong credit and 3% down, I can put you in a Nebraska first time buyer loan where you get some home buyers assistance, things like that.
I want to ask about really strong credit.
Yeah.
Because I think that's obviously when we're talking about the market, it differs, right? What would you consider today really strong credit, like number wise? 680? 700?
Yeah, I mean 680 is solid.
Okay.
NYFA requires a minimum of 640
okay.
to qualify for their products. It's not just about the score though, right? Like your
longevity and
your debt load plays a huge factor as well.
How much money you have in your bank account.
So, but when you get, for whatever reason, I don't know what the exact threshold is because it's ever changing. But when you hit in between certain tiers on credit, FHA
dollar amounts change.
Well, FHA probably becomes the route to go if you don't have 20% down, because the mortgage insurance can get a little bit more expensive.
Sure.
Or a lot more expensive depending on the scenario on a conventional.
A lot of people, their credit improve after they buy a house. If it doesn't, that's usually not a good sign anyway. But they get high. It gets high enough for that mortgage loan or the mortgage loan to drop off.
Mortgage insurance.
I'm sorry. Thank you. The mortgage insurance drop off. What advice do you give to people who are thinking about requalifying and refinancing to get that to fall off?
I think you look at your cost analysis,
Thank
right?
God we talk for a living, huh?
So if your mortgage insurance is on a conventional, let's say it's $85 a month, right?
Sure.
Is saving $85 a month worth potentially paying $3,000 to $5,000 for a refinance?
Yeah, or an extra $120 a month on the
principal and interest if you have a super low rate. So
right.
It's all about cost analysis.
Sure.
But on the conventional side too, if you
does that ever fall off like after a certain time without
conventional, it does. Yeah.
Yeah. Okay.
FHA does after 11 years if you put down 10%.
And with conventional, it falls off
naturally at 78% loan to value.
I got you. Okay. And we're catching up with Alex Drake here we're catching up with Alex Drake here on the Spotlight Omaha podcast, brought to you by Pixel Fire Marketing and Pyramid Contractors. Alex is with Lincoln Federal Savings Bank, member FDIC, equal housing lender. I want to talk about your journey into this industry because obviously anybody that hears you talk about this, you're kind of a nerd for the numbers. You obviously love what you do. You have an illustrious college basketball career. You have a historic run as a college basketball coach, but you end up getting into the mortgage side of things. Why was this the right calling for you?
Yeah. So, man, it's weird. So there's a point in time, at my last employer, just working as a personal banker, and I felt like I was capped. There wasn't a lot of room for growth.
Sure.
I had the mortgage loan officer inside that branch call the manager who eventually hired me to the call center. I just wasn't happy.
Sure.
And that company was a great place to work for. I just wasn't happy in that role. I ended up taking the position and for like 2.5 years, really didn't do a lot besides answer phone calls and transfer them to other loan officers.
Sure.
Because it was kind of
discouraging.
It was.
Okay.
So it was kind of a training ground at
Sure.
that time. But it wasn't a heavy refinance market. And because
that probably plays a little bit of a role.
Yeah, when we weren't out, it's because we weren't out beating the streets. We were encouraged to
wait for the call.
Well, wait for the call, but you transferred purchase transactions to nearby loan officers,
sure.
To those clients. And also at one point I got paid more to pre-qualify somebody and then have somebody else close it than I did to close it myself. Yeah. So, but yeah, I mean, there was a point in time there too. My wife and I talk about it all the time. I'm beyond blessed that it worked out the way it did, because there was a point in time, late 2018, early 2019, that from my cubicle or private rooms on my floor at the tower, I was doing Skype and Zoom interviews for other companies, and the jobs I wanted I didn't get, and the jobs that offered me I realized I didn't want.
Yeah.
So, and then late 2018, early 2019, there was kind of a shift in that division and that team. We brought on like another 10 loan officers. We were going to go national. We ultimately did go national, and I really, because of who I got to sit next to that came over from another company, really discovered a passion for that industry. And man, it's been such a blessing. You know, I found a new way to coach people.
Nice.
Right.
Okay.
And,
I like that.
Coaching, I knew at a very young age when I was playing basketball that I wasn't going to play in the NBA.
Showing up on ESPN.
Yeah.
People forget.
I knew I wasn't going to play in the NBA, but I always wanted to coach.
Yeah.
And then when I got the opportunity to be a volunteer at Creighton, and then
shout out Steve Murfeld.
Yeah. Thanks, Coach. And Mick Johnson, who got me the interview with Coach Murfeld as well. And then Creighton helped get me a gig as an intern helping run camps outside of Philly and up and down the East Coast. That following summer, I realized that also wasn't the life that I wanted, right? Like
being gone a lot.
It was super hard to get to the level that I wanted to. And at that point I was 24 years old. I was starting to have real bills, and $22,000 a year as a part-time assistant coach at a small college wasn't going to
You weren't making $1 million a year?
Yeah. So that wasn't going to get it done. But yeah, to your point, like I remember seeing coaches gone all the time. They were in the office all hours of the day, and that would have been a really tough life. I hadn't met my wife yet, but I knew that would have been a really tough life for any partner that I had found, and my kids. And I wanted to find a way to be able to still make a difference in my community and still be there for my wife.
Why is it a big deal for you? Because we've talked about that. Why is it a big deal for you? You grew up in La-Vista. We talked about that. Why is it a big deal for you to be able to do business and help other people in Omaha buy homes in Omaha?
Yeah, I think there's just I think it's just how we're ingrained, right? Like,
sure.
In the Midwest, like we all want to go make a name for ourselves in some regard, but I mean, you doing this podcast, you're helping business owners and people all the time, and I think what you do here helps put general consumers.
I give myself enough credit. You don't have to. No, do
that. But I think things like this help get the right people in front of consumers so they can make informed decisions. And I've always said since I got into mortgage and I got into like the retail space where I meet my clients face to face more than phone and email now, that I don't want it to be scary to come in and meet with a mortgage loan officer. I don't want it to be scary to come meet with.
You don't want to be the dentist.
Yeah. I think everybody should have the opportunity to achieve a homeownership if they want to, and it's right for them.
Yeah.
And if you're not ready, I want to do everything I can do to help you get ready.
I want to talk about that because we're way over on time, but this is a good conversation. Best piece of advice you can give to somebody that's looking to buy a home for the first time, and what are some red flags that tell you that should tell that person they're not ready?
Yeah. So, I mean, it's relative, but living paycheck to paycheck makes it really hard. It used to be that your mortgage payment can be less than rent. That's not really the case anymore with rates, prices, taxes, insurance, all of that stuff. So my biggest advice to people is dial in your budget, figure out what you're comfortable with from a monetary standpoint, talk to a lender.
Do you have money to eat?
Yeah. So one thing I have a handful of clients that I stay in touch with that have still never bought, but we've set them up on various things, whether it's I get them in touch with a credit counselor because I'm not certified in that, and I'm not I'm not going to steer you the wrong way.
So you want to make sure they get the best advice.
Yeah, so I'll set them up with a credit counselor. But if it's simply like dollars and cents because of debt load or whatever it is, we
can move a decimal and carry a one.
Yeah. So like a lot of my clients will run prospective housing payments at $250,000 or $300,000, whatever it is. And I tell them, okay, here's your rent, right? Here's what you make a payment in rent. We'll say it's $1,700, but the payment at this $300,000 house comes out to $2,500. What you need to start doing today is taking that missing $800 and throwing it in a savings account every month. Pretend like it doesn't exist. Open a savings account at a bank. Don't set up online banking. Transfer that money to it every month.
And forget it.
Make it impossible for you to touch it. Because A, that gets you comfortable with that payment, but B, it also helps you save faster. Pay off credit card debt. That's a big one.
Sorry. When we talk, like, you mentioned that you don't deal with commercial, and we talk about growth. Like, is that something you'd like to eventually get into? Is it so difficult and so different to do residential versus commercial that you want to live and be, to your point, a subject matter expert in this versus commercial where you don't know as much? How does that work from a loan officer standpoint?
Yeah, so I'm definitely a novice when it comes to commercial. My understanding on the commercial side is there's not nearly as many regulations and guardrails, meaning
because usually they've got the money to buy a large building, or they don't, right?
Meaning each institution can change their own lending guidelines and appetite for whatever at the drop of a hat, which to me would be a really hard world to live in as somebody advising clients. Like, but also,
and it feels like you'd be a little less in the coaching role in that standpoint, right? Too,
yeah, a little bit. And I just. There probably is as many, if not more, transactions happening.
Sure.
I'm good friends with a commercial real estate broker, and he seems to be running around like crazy.
Yeah, I know a couple as well.
But those deals also take a lot longer to get done.
Yeah.
And while I love working with my clients for 6 to 7 months, if that's what it takes, I really like being able to help more people in a shorter amount of time and just. And then, you get thrown into my phone and we touch base. We chat about holidays. We catch up. I just had a client close their loan a couple months ago at the hospital because they got in a car accident the day before closing. And they just sent me pictures of their newborns. And yeah, no, it's great. Like, I've made a lot of friends out of my clients. And while that would happen in the commercial world, I just
couple local media members you've helped out.
Yeah, I just don't think I would get that same level of opportunity that I do in residential, and I don't know if I'd feel the same way about it.
I want to talk about growth in the Omaha area because obviously Greta's exploding. Elkhorn's seeing a renaissance. They just put a ton of money into North Omaha.
Yeah.
South Omaha's expanding almost into Plattsmouth at this point and past Bellevue. When you see that type of growth, I think on its face, I would say good news for your line of work. Is it as simple as apples to apples in that situation?
No, not necessarily. In the grand scheme, yeah, but I don't think it ends up as immediate relief.
House has got to be built, right?
Yeah, but I think that's part of the problem that we face here. Like, there's other markets around the country that have had housing shortages, like we have. Las Vegas being one of them. You know what Las Vegas and Phoenix and all those places get to do? They get to build year round.
Yeah.
So
famously doesn't get very cold in those areas.
Yeah, so we get a little bit of a disadvantage there, but there's a ton of multifamily, like up in Blair, where they're doing a ton.
They're dumping a ton of money into that community as well.
Yeah, but they're doing a lot of like multifamily units up there, apartments and things like that.
I think a lot of that is because there's obviously the packing houses and different factory working type stuff up there.
Yeah, but I think if you just drive around Omaha, retirement communities and apartments are being built all over the town too, and
that doesn't really help the lending market.
Yeah, this number is going to be obsolete now because I haven't talked to the property management company that gave me this a couple of years ago. But at one point, Omaha was sitting at like, this is probably wrong, but I want to say it was like at 94% occupancy on multifamily rentals. And I think they said they wanted to be at 85 or below which is why you see a surge in that.
Sure. We're way over the point where we tend to wrap it up. But is there anything? How do people get a hold of you if they want to talk to you about getting a mortgage and maybe get a little bit of coaching as well?
Yeah. So you can follow me on LinkedIn or find my business page on Facebook. I'm sure you'll tag it.
Yep.
I don't remember how it's titled officially.
Yeah, I'll get it there.
And then, Google me at Lincoln Federal.
Is there a phone number they can reach out?
Yeah, everybody gets my cell phone, so you can call me at 402-960-0128. That's the best way to get a hold of me. Call, text, email adrake@lincolnfed.com.
That's Alex Drake with Lincoln Federal Savings Bank, member FDIC, equal housing lender. We're going to do 3 more podcasts together today. I'm looking forward to it. We're going to cover the Creighton game tonight. Hopefully you can join us on 1620 The Zone as well. We'll be back tomorrow at 11 a.m. right here on the Spotlight Omaha podcast. We're going to catch up with a chiropractor here in the Omaha area who's got 2 locations, 2 different parts of towns. We'll get their aspect or their thoughts on the different aspects of working in 2 different parts of Omaha. We hope you can join us tomorrow at 11 a.m. here on the Spotlight Omaha podcast, brought to you by Pixel Fire Marketing inside the Pyramid Contractor Studio.